All right, welcome to this episode of Market Shares. I'm your host, Tony Blodgett, and today we're going to dive in and talk a little bit about just what's going on with the market, just a market update that I think is going to help a lot of people. Now, look, I'm not going to get too far in the weeds with technical data. I'm definitely going to cover some of the reports that have been out recently, but I want to talk a little bit more, I think, philosophically about the market and where we're at. I mean, here we are just 10 days into the month of February, 2023. And, it's already starting to shake out to be a different feel to this year than the way that we ended 2022. And I think for those of us in the mortgage and real estate industry, that's very welcome news. So let's talk about a few things. First of all, I was just looking at numbers just this week, just the other day, and I was seeing that applications, now this is very anecdotal, but for the company that I work for, I saw that mortgage applications, this is just like in our system, right? Through our point of sale system, I saw a 60% increase in mortgage applications that were started and completed by a borrower in January versus what we saw in December. Like, that's a huge increase. And I've been hearing numbers like this in many of the conversations I'm having with folks around the industry. I have a lot of industry friends that run, production numbers and run production for large mortgage companies. And this is similar numbers. I've heard anywhere from as little as 20 to 25%, all the way up to 40, 60% increase in application activity. So I think for all of us, that's very welcome news. Now, I did just read a report that the MBA reported that mortgage application data that came out on February 1st showed a weekly decline. So, we saw massive surge in January over what we saw in November and December. And then it looks like the end of January, the report that came out, just a weekly report, came out the 1st of February, showed maybe those numbers dipping back down a little bit. But I can tell you, just based on what I'm seeing around the industry, is that mortgage applications are way up. Activity is way up. Contracts are increasing. We're seeing some, people not able to get contingent offers accepted. We're seeing multiple offers again. So all of the signs that the market's coming back, and it's early. Typically we usually see the market start to shift, in my opinion, towards the later half of February. And to see it come so quickly when the calendar turned over to 2023 was very welcome news. I joke often about my favorite holiday of the year. When people ask me, I say, well, it's President's Day. And you say President's Day, no one says that's their favorite holiday. But for me, that almost always signifies the turn in the mortgage market. And this year, I got to say, it came early, and that's very welcome news. So again, some of that's anecdotal, but man, activity is way up. If you're a home buyer and you're thinking about buying this year, I got to tell you, all this talk about the market picking up and getting back to a more competitive market, it seems, as we are here at the first part of February, it seems to be playing out that way even this early in the year. Now, let's shift a little bit and talk about inflation and what's going on there. We just had a Fed meeting last week, and as expected, we did see the Feds increase the benchmark rate by another 25 basis points. The market was pretty volatile that day. If you were sitting there with some loans to lock, you initially saw the MBSs got a lot worse. The mortgage rates got worse for a second, and then they snapped back up, and we did very well. Matter of fact, we had some price improvements that day. So again, back to the counterintuitive nature of when the Fed raises interest rates, in this case, mortgage rates got better. But that was very short-lived, because what we got on Friday was a jobs report that is just out of this world. We saw 517,000 new jobs created, way past what the expectations were for that report, and almost unbelievable. And as we really start to unpack what went on in that report, turns out it's not as clear as it looks like. And this is on the heels, by the way, of an ADP jobs report that came out earlier in the week that showed like 106,000 new job creations. But it turns out that in that Friday's jobs number, that headline number being 517,000 new jobs, I mean, the market didn't like that. I mean, the mortgage market didn't like that. Interest rates didn't like that, because that shows that the Fed is going to have to continue with their rate increases, because they made it pretty clear they don't pivot until not only does the economy slow down, but we see the jobs market soften. And when you see that many new jobs, you go, well, geez, we're nowhere close to seeing a softening in the jobs market. But upon further review, you guys, I'm not going to get into dissecting that report, but I will say this: year over year, not any increase in full-time jobs, okay? Almost all the jobs that have been created are part-time jobs, but this report in particular has some other adjustments to it. There's some seasonal adjustable components to it, and there's also some population control adjustments to it. And the seasonal adjustments were over $2 million, close to $2.5 million adjustments. So look, there's a lot of chaos going on under that headline number that I think is going to play out here as we move forward. The jobs market is not nearly as strong as that report indicated that it was. But again, this is what we're up against now, you guys. We're up against, a lot of volatility, and the whole market is hanging on the breath of every statement the Fed says, every CPI report that comes out, jobs reports as they come out. Like, what is the direction? What is going on? So I think the overarching theme here that I want to communicate to you guys is you got to expect some volatility as we move through, I think, for sure, the first quarter and probably the first half of 2023. So here's some other things to keep an eye out. And I mentioned this on a previous podcast, but March CPI number. Remember, we showed you how the year over year numbers work, and maybe we can throw that graphic back up here on the screen really quick. But if you remember, there was a very low read on CPI back in March of 2022. And so if we don't have another really low read this year, which we have been, as long as it stays where it's been the last couple months on the inflation numbers, it's not going to be an issue. But we don't have a whole lot of room for that to increase at all. Now, if for any reason we see a CPI number in March that exceeds what it was March of last year, and I believe it was 0.3%, if that happens, then you're going to see the market overreact and freak out, just like they did to this jobs number that came out last Friday. So I'm worried about that. So if you're a loan officer and you have a floating pipeline, I'd be very careful as we move in to March's CPI number that comes out. And there's just going to be a lot of these big reports that you're going to want to be careful and protect your pipeline in a market like this. Now, in addition to that, I think communication here is going to be really important. I'm going to summarize as we wrap up this podcast on kind of where I think things are going to be. But the bottom line is your messaging to your clients and your referral partners, the realtors that you work with, you need to explain that this volatility is just part of what we're going to deal with during this time of stabilization in mortgage rates. So this is no surprise. We expect there to be volatility. And if you're pre-approved and shopping for a home, those clients in particular, you have to stay close with. You have to set the expectation on what's coming in the coming months that could impact their interest rate, and that you're going to have your finger on the pulse of what's going on and advise them on the right times to lock or to float, etc. So more to come there. Another thing that we're dealing with right in the midst of all this is we've all seen the changes that Fannie Mae put out to their loan level price adjustments. I'm going to say in general, these LLPAs are going to make it more expensive. That's going to increase the interest rate in most scenarios for well-qualified borrowers, cash-out borrowers, etc. There's obviously circumstances where they have lowered the LLPAs for certain loan to values and FICO scores, mainly on the lower range to make it more affordable. And I think for some people that's a positive. But overall, I would say these LLPAs are expensive, and they're going to counteract a little bit of the rate improvement that we are expecting to see as we move through the next few months. Now, those LLPAs are for loans delivered to Fannie Mae after May 1st. So as a result, that means companies are going to start implementing these way before May 1st. I've heard some people as early as February 1st, so they're already in place at some companies. I've heard some on the 10th, some on the 15th, some March 1st. So sometime in the month of February, if not already, you can expect your companies or the company that you're working with to get a home loan is going to be implementing these LLPAs. So make sure you talk to your loan officer about that. And if you're a loan officer, communicate this to your potential borrowers or your active borrowers that there's some changes coming to LLPAs on conventional loans. So I talked about jobs report. I also read that England and other European central banks are talking about the need to also increase interest rates because of their fears of inflation. I feel like here in the U.S., which we kind of lead the global economy, besides that jobs report that we saw and some other, which I think has a lot of issues with it, besides that, I think that the worst of inflation is behind us. I don't expect a huge issue in March. I just know that it's possible because of the low read that we had. But I think all in all, you're going to see signs of inflation on multiple fronts start to improve. So I think the Bank of England or the England the federal bank is a little bit behind the times, and they're seeing things like this job report and overreacting. But it'll be interesting to see, what happens there if, in fact, you see other countries raising interest rates with the same fears of inflation. So, you guys, here's my take on what's going to happen in 2023 with this market. I think that it's no surprise that we're dealing with volatility right now. I'm a little surprised at how quickly mortgage applications picked up in the first, in January of 2023. Pleasant surprise, and I think that it just shows that there's pent-up demand, and it's going to be a very robust spring buying season. I think it is going to put a stop to the decline that we've seen in many areas with home rates, with home values, because there's just a very low inventory, and as more and more people come out to compete for those homes, you're going to see the home prices stabilize. In my opinion, we've been calling for that all along, but it's going to happen sooner than later. Between now and May, I think we see quite a bit of volatility. There's many signs that the Fed is not going to be able to bring this to a soft landing, that we're going to see a recession in the second half of the year. There's some indications that that might not happen. So I think that it's either going to be, the Fed's going to accomplish their goal of really slowing down the economy nice and smooth, or they're going to put us into a recession. Neither of those are great for the economy because we need to bring inflation down. But these things are good for mortgage interest rates and will be good for the housing market, in my opinion. So you guys just, pay attention, watch the markets closely more now than ever so that you can advise people on what's going on. Because here's what we're trying to change right now is buyer sentiment. We first thought when rates went up in 2022 that the issue was affordability. They can't afford the homes. But what we realize is it's not so much affordability. I mean, that's part of it. Don't get me wrong. Some people get priced out of the market. But with rates improving a bit, home values softening a little bit, the affordability is not what we're dealing with right now for the most part. It's sentiment. It's how do people feel about the housing market? How do people feel about interest rates and the direction of things? And that we have influence over. That, if we know what's going on, and when people see the headline, we can say, hold on a second. Don't pay attention to the headline. Here's what's really going on. When we can give people advice ahead of time about what we think is going to happen, and then it happens, that creates confidence in our realtor partners and our buyers. So help bring that to the conversations that you're involved with by knowing kind of what's going on in the marketplace. And don't be afraid to put yourself out there and say, these are the kind of the key areas we need to be watching for and looking out for. And as we get through those, update your clients and your realtors and the people that you work with about what happened and how it impacted the market and kind of where we're going from there, because we need to keep the borrower sentiment positive and the momentum moving in that direction, because it's going to be a little bit of a bumpy road, but we're here to help navigate through that, because we do know that interest rates towards the second half of the year will be much lower than they have been, and the housing market will be right back off to the races, and you want to advise your clients to be in early, not waiting on the sidelines for that to happen. So I hope this was a helpful update. Every so often, we want to come in here and just kind of give you a sense of what's going on in the market. There's lots of resources if you want to dig into any of these specific events that I'm speaking about. But what I want you to understand is more the big picture and how you can help curate that and help your clients and the people that you do business with understand what's going on with the big picture about housing, real estate, and mortgage interest rates. So with that, you guys, until next time, thank you for your time and attention. I'm sure if you're watching this, you're already a subscriber, but if you're not, please subscribe so that you get notified every Friday, 10 a.m. We push out a new episode of Market Shares. Sometimes they're interviews, sometimes they're market commentary. And if there's something else you would like us to talk about on this show, please leave your comments down below or find some other way in which to reach out to me. I'd love your ideas and I'll be more than happy to bring that to future content. And until next time, take care.